Income and Chief Investment Officer Sarah Malik. Sarah, it's great to have you on a day like today, and I want to get your reaction to what we just heard from Jeffrey Gundlach, especially since, A, we know it was a hawkish cut. That was pretty well telegraphed going into this rate decision and this meeting today, but the market does seem to be pricing in, perhaps, as of right now, post-meeting, less than one cut next year.
So I think the reason why they did the cut is they said they already do the cut, and I think it would have really shaken up the markets if they hadn't, even though it seems a little bit more common sense, but the markets can act pretty irrational when it comes to new news. If I remember the wording, they said the inflationary pressures seem to be a little bit sticky, which is I would be somewhat concerned if I was in the Trump administration, because a lot of stuff is going to be pro-inflation, even though it's going to be extremely pro-growth at the same time.
Less than two cuts next year.
Yeah, it's great to see you. I think that there's three reasons the Santa Claus rally ran out of steam this week, and that's because of the Fed, also inflation, and also market breadth. So let's start with the Fed. Markets did expect that 25 basis point cut today. What they didn't expect was the Fed to signal only two cuts next year. I think the reason for that is because of inflation. That last mile of battling inflation and getting it to the 2% target is going to be very challenging, especially with some of the policies that may come into play with the new administration. And then technically, this market has been looking weak for quite a few days now. Just looking at market breadth, as of yesterday, only 45% of S&P companies were trading above their 50-day moving average. The last time we saw that level of weak participation was in July, where the markets dropped almost 10%. So technically, there's already been a flag saying, you know what, this market is running out of steam.
So is it a buying opportunity then? How do you think about it here as we do have this pullback and as we do have a Fed? We always talk about don't fight the Fed. I mean, what does that mean now?
I think, first of all, you're going into the low liquidity end of the year. I don't think this is the time to be rushing in to buy. Second is that there's a lot of variability around that forecast for two or a little less than two rate cuts next year, because, first of all, the economy looks strong right now. So given that the Fed's saying strong economy, sticky inflation, we're going to cut.
Look, they might have just, and it wouldn't be the first time they worded something wrong, but at this point in time, given what we know now, I don't think that they're going to cut anymore in 2025, which is, that would be a shame. It wouldn't help the 10-year, which wouldn't help the housing market. And, a lot of these, building companies are poised for a new building cycle, but, we'll just have to see.
Rates less than what the markets expected. But on the other hand, we're now going into multiple years here of the consumer and employment markets fighting that inflation battle. And at some point, the consumers in the employment market are likely going to lose that battle if inflation and high rates stick around. So you could have this other side of the coin where the economy finally weakens in the second half of next year and then rate cuts accelerate. I think that's the challenge for investors, is how do you invest in that? We personally like small caps for 2025. Strong dollar, positive for smaller domestic companies. Tax cuts good for small companies and spending there.
Well, you mentioned what's best. Let's zoom out even further. What do you do with fixed income here, perhaps for tax advantages? Talk about munis.
So the fixed income market, the yields are going to decrease on the fixed income market. Again, this is not financial advice, and this is just for the purposes of education only, right? He's going to talk about municipals. Municipals have some tax advantages, especially if you get a municipal bond in the state you're in or from a territory. You don't pay federal, state, or local taxes on it, right? So what you could do with the interest rates dropping is that you could buy, for example, a discount bond, right? A discount bond would be a lower, the way it works is you buy it at a discount, meaning it's below $1,000. The interest rate on it would be a little lower than what the market rates are, too. That's why they're offering it a discount. If the Fed is to continue cutting, right, the that interest rate would become more valuable, right? Because you're not getting the same coupon rate, right? Those are being pushed out anymore. So your discount could possibly go to a premium on those bonds. So if you're a person who thinks that rates are going to continue to go down, that's something that a person would add to their portfolio. And I gotta, being an industry professional, I have to talk about this too. The downside of that is, let's say they go up, right? Your discount is going to increase until the bond matures and it reaches parity.
Talk about credit quality.
Sure. Well, it's definitely credit quality over duration. Munis are a great example of strong fundamentals here. States are very strong. Strong economy leads to strong rainy day funds by the states. So I think munis, it's a buying opportunity because the total return in a higher rate environment can be very strong for those. Fixed income, you need to look at in areas where, such as senior loans, floating rate loans, which are areas that are less dependent on the Fed cutting rates like the market had been counting on.
Is it?
I remember a few years back, Puerto Rico was offering a bond at like 9%. And if you think about that's something you didn't pay tax on, that was like one of the most amazing deals ever.
Harder to get investors excited about fixed income, given what equities have done over the past few years, and a year where, despite a day like today, we're still up. It's got to be what, 25, 27% on the S&P.
I think it depends. Are you looking in the rearview mirror or ahead? Equities are coming off 2 years of back-to-back 25 to 30% return. So, a lot of that has been baked in. If you look at the multiple for the S&P 500 trading at about 23, 24 times earnings for next year versus median multiples that are around 18 times. Even earnings growth for next year looks optimistic for us. Markets expecting 15% earnings growth in 2025. Median historical earnings growth for the S&P 500 is about 7-8%. So a lot of optimism going into equities. Now in fixed income, in a higher rate environment, you can lock in some strong total returns there. So if I'm looking forward, I think fixed income looks a little more attractive, but pick your places in equities that have lagged like small caps.
Safety usually does.